the next 45 minutes, we're going to talk about institutional digital assets products. We, in this forum, we like to talk about accounting and having technical discussions around taxes and stuff like that. But we also like to open a little bit the discussion. But we will speak about sub 121, so that's fine. So right away, let's jump right into it. We'll, if each of you can introduce yourself, tell us a little bit about the company you're presenting and what you guys are doing, and then we'll jump right into it. Maybe Caroline, do you wanna start?
Sure. So Caroline Butler, I run digital assets at Bank of New York. I took over that role. I was actually explaining to some of the guys on the panel in October 22. So I left a very steady job running custody to jump into digital assets just in time for everything to go. But we stayed convicted. We can talk about it later, great product. And we're really looking across that entire value chain across the bank. So very excited to be leading the charge in BNY.
Great. Adam?
Adam Sporn. I lead BitGo's prime brokerage and U.S. institutional sales teams. BitGo is the OG in the custody space. We were 10 years ago, 10-year track record. Today we support over 850 tokens and coins. We have over 1,500 institutional clients, and we help them safely store, trade, stake, and finance their digital asset strategies.
Great. Teddy?
Hello. I'm Teddy Fusaro. Excuse me for that. I am the president of Bitwise Asset Management. We are a cryptocurrency and digital asset management firm founded with the goal of bringing crypto products wrapped in traditional structures like exchange-traded funds, exchange-traded products into the marketplace so typical financial professionals and mainstream investors can access them in the same way that they access their other investments. Similar story to Caroline in terms of time to market. We first filed for a Bitcoin ETF in 2019 in the US. I had a lot more hair and didn't have a gray beard when we started the process. So we finally got that to market in January of this year. We recently also acquired a European asset management business. So we're now a global firm. And looking forward to chatting with this panel today.
Great. Romai?
Hi, I'm Jean-Marie Mognetti. I'm the CEO and co-founder of CoinShares. CoinShares was created in 2014. It's an asset management company. We're running about $7 billion for our clients, exclusively in digital assets. And we are sprinkling freedom in investment portfolios since then. So the story is building.
Cool. So when we talk about regulated institutional products, obviously the products that come to mind first are ETFs, and especially Bitcoin spot ETFs. So we'll start with that. Maybe we'll start with you, Teddy. Where are we in the adoption cycle of the Bitcoin spot ETF? Obviously, we're at the very beginning. We got listed at the beginning in January in the US. Where are we?
Yeah, a question that we get a lot. I'll tell a quick story as an example. So our chief investment officer, Matt Hogan, who some of you may follow, he writes a weekly CIO memo and speaks publicly a lot on the crypto markets. He was speaking at an event, Barron's financial advisor event, the beginning of last week. It's an event for the top financial advisors in America. They host every year, 2 times a year. And the question he asked the room was, raise your hand if you personally, in your personal account, are invested in Bitcoin, crypto, or digital assets. Nearly every hand goes up. Follow-up question, raise your hand if you're putting your clients' assets into Bitcoin, crypto, or digital assets. And less than a third of the room puts their hand up, maybe about 25%, 20%. And I think that's a really good indication of where we are. I mean, it's easy to look at Bitcoin ETFs coming online this year in January, BlackRock entering the space with their own product, Fidelity entering the space with their own product, several other large asset managers coming to the space with their own products. Bitcoin ETFs, when you measure them, have been the most successful ETF launch in the history of ETFs. ETFs have been perhaps the most successful financial innovation of the last 30 years. So it looks like it's a big deal, and it is. I don't want to say that it's not. But as we start to think about traditional mainstream investors, banks, wirehouses, platforms that actually onboard this stuff, getting advisors and clients to allocate, I still think it's very, very early in the cycle. And it's going to take some time for that due diligence process to play out, for it to find its way into models, investment home offices. It's going to take a little bit more time for this to play out. So I think it's in the second or third inning.
And so would it be fair to say that today, like the demand is mostly led by like retail and less by like large institutional investors?
Yeah, I think so. And Jean-Marie has been running a crypto asset manager for a number of years as well and may have some perspectives here. But certainly we saw a large amount of pent-up demand from the retail community that came online at the beginning of this year when Bitcoin ETFs came to market. Whether or not we, as sort of people who are building in the crypto market, want to hear it, mainstream retail investors are just much more comfortable allocating to products from their brokerage account. It is a lot more challenging for them to go out and manage a whole different portion of their financial life through a whole different set of logins with a different app and a different nomenclature. It's just not the easy button, and ETFs are the easy button. So we saw a massive influx of retail demand. We did see a ton of institutional participation, so I don't want to discount that. The savvy institutions, a lot of hedge funds, even some pension funds, financial advisors, the savvier ones, the larger ones are absolutely allocating on behalf of clients. But I do think the early flows were largely driven by retail phenomenon.
And Jean-Marie, so you have, you run like ETF, ETP products like all over the world. Like, do you see different dynamics and different types of investors in different geographies? And how do you see the evolution of demand across these different markets? And then also we'll talk about maybe the different products and the different assets themselves and how this is different.
So
customers.
I can't quote Matt Hogan again, so I'm going to quote a German scientist called Max Planck, who say innovation goes one funeral at a time. So it goes very slowly, and the effective penetration rate of crypto into institutional portfolio takes a lot of time. There's a lot of discussion going on, but the pipeline and the time to conversion is very, very slow. Caroline going to tell about the story of Bonnie later, and you can see that moving these animals takes a lot of time. So retail was the first one, and crypto is probably the only investment proposition in the last 50 years which has been driven by retail first and institution second. Which means for once, retail don't get the crumbs and are benefiting of the full appreciation of the asset class before the institutional demand. And it's pretty new. So we're not very used to it. And when we started our journey in 2014, everybody was like, oh, we need to get the big boys to allocate, and the allocation from the big pension and insurance company. And none of them were coming. They're all searching. And to date, we probably have still 75% of our portfolio, which is composed of retail investors. And that's 10 years in, with a massive focus on Europe because the US were deprived of product for the last 10 years, effectively. Save for the last 9 months. So it's a very, very interesting book building exercise, which is completely different from any other product people see in their life as asset management company. So something to remind.
Okay, great. And beyond just the Bitcoin spot ETF, like how, what are the narratives that are resonating in the market today for the other assets? Obviously, the ETF started to be traded a few months ago. Like, what is the narrative behind it? What does the resonate in the market today? And where do we go from here? Maybe Adam or Caroline.
So from my perspective, when we think about Bank of New York, right, and you think about custody in particular, it's just another asset class, right? It's just another market. So in some ways, ETPs, ETFs, whether they're US or not, or even private funds, right? If we think about that nexus into the traditional services that we provide to be able to power up our clients, to enable them to deliver products, in some ways, we've got to look at it that way. It's just another market, just another product, and we do the same thing. Now we're doing it differently. And to what Teddy and Jean-Marc are talking about, we're very, very, very accustomed to dealing with institutions and the institutional experience, which has been a pretty miserable user experience over the last multi-decades, right? So now we're put under pressure in a positive way to actually look through to the retail experience. And I think it's helping us to even do very traditional banking things, whether it's payment services, issuer services. A lot of what we do on the fund servicing side, obviously we're servicing, I think it's 85% of the ETP market right now from BMY on the fund servicing side. But how we're showing up in terms of how we're looking through our asset management clients right through to that retail investor, I think we'll actually end up in a better place because the retail investor will push that experience through. So again, whether there's a proliferation of different underlying assets wrapped in an ETP, tokenized funds, we're seeing a huge creativity in that space, which is doing something very interesting for us. Transfer agency. Do people even know what that is? Right? Why would you? You wouldn't have known what that was years ago. It's back-end pipes and plumbing, record keeping between an issuer and an investor that BNY manages. Now you do that on blockchain. You've actually got this last mile friction that is we need to enable as a digital provider to be able to clear those ranks. And these are very back-end pipes and plumbing things that have now actually become part of that user experience, because guess what? You've got the digital investor logging on to the portal that is a BNY portal, and they will have zero forgiveness for that being an old school mainframe looking portal. They'll want a different experience. So even on that very synthetic layer, I think we're pushing the industry because it started in retail.
Yeah. Adam?
One thing to add on the ETH ETF, I think something that is impacting the demand in the U.S. is the lack of staking. We see lots of we custody, we stake for lots of other ETH products, and so if an investor has a choice to go into it and earn an additional 3 to 5%, or do the ETF, I think that is holding some of the demand back in the U.S. market.
Yeah, absolutely. Beyond spot ETFs and ETP, Caroline, maybe I'd love to hear from you from BNY Mellon perspective. What has been your journey to go into this regulated crypto market, and tell us a little bit about the roadmap, where you guys are going, and the types of products that you will focus on in the future, and maybe we can do a little segue to the custody piece and the sub 120.
The infamous sub 121. So we started probably 5 to 6 years ago. The first capability was custody, and it sort of makes sense. The Bank of New York Mellon is the custody bank, right? It's $50 trillion worth of custody that we manage. So we very much felt that we had an obligation to solve for the gap that was in the market. And we've been knocking around for 240 years. So being able to evolve from what I see as very much part of our core is just a digital ledger business. We started as a ledger business. We've got the very first ledger of the bank sitting in headquarters. It was actually Alexander Hamilton's ledger, by the way, founded our company. So pretty cool. It's a nice storied history that we have. But it's a good reminder. You see this physical ledger. It was his wife, by the way, that put the first entrance, so even cooler. But you actually see it and you go, guess what? This is just natural evolution. Our obligation, take the latest, greatest technology and keep evolving the industry. So we started with custody, and that's kind of that first rung on the ladder. It was part of our digital asset platform. Yes, we started it in an environment that challenged our emotional resilience, my personal emotional resilience. But what we did was we leveraged the sort of gap in the market, or the gap of timing, to be able to bring that product live. And we started creating tokenization capabilities around it. So it's all implicit in the same digital asset platform, but we started leaning into whether it's digital records, agnostic to the asset, whether it's a liquid asset like bonds or whether it is a fund, bringing that product live as well. And we kept building those capabilities. So now what we have is a digital asset platform that is deeply integrated into the traditional. That was brutally hard to do, right? Because you're talking about very slow mainframe technology that's on a scale that can manage the trillions of assets that we manage on a daily basis. But we took that time to be able to do that right. So now, when we have product market fit from asset managers, we're able to just springboard in those capabilities, convert them into a product, work with our regulators to make sure that we've got the permission to bring them to market, and do that in a global way. So I'm an optimist at heart, so taking advantage of that time, we've been able to really look across the marketplace. And what we're seeing in terms of client demand now, that I think is quite different, and I'd be curious on your perspectives on this, is we're seeing less of that desire to run after leveraging blockchain technologies for pure efficiency or disintermediation. And we're seeing a lot more of that chase of how do you actually increase utility of your assets? So make your money work more for you. And if you think about what we do in BNY, we run the gamut of issuance right through to all of the back-end servicing that is required for that. And we're actually able to leverage that technology to power that transferability. So even money market funds who have legal restrictions on transferability, we're the world's largest collateral manager. So getting utility out of your assets and putting them to work into the collateral ecosystem, that's where we see our obligation on behalf of the industry to leverage that technology to do things like that. So our digital asset platform connected into our underlying custody and collateral management is a key value proposition for us to enable the industry to keep advancing.
Very cool. Adam, given that you're also working with most of the asset manager and you are from the sort of the technology provider side, how do you keep pace of innovation and how do you make your platform evolve to be able to support asset managers that want to do new things and build new products?
Yeah, it's not easy. That's why 60% of our firm is engineers. So I break it down into two ways: is new coins and new products. So two-thirds of the 30 largest VCs are custody clients at BitGo. So when a new coin launches, they're knocking on our door to be able to provide it QC on day one, not just for custody, but also for staking to be able to earn that incremental yield. So I mentioned earlier the 800 coins and tokens, about 35 layer ones. And so those clients want us to be there to support it for layer one on day one. So we announced this week Eigen. If you look back over the last year, from Sui, Say, Tia, Zeta, WorldCoin, all there day one for our clients, for both VCs and asset managers. So that is a huge focus for us. And then you think about new products, and at BitGo, we've been focused on taking some of the themes in traditional finance and moving into digital assets. So DVP settlement, we saw a lot of risk in the system post 3 Arrows, post FTX. We'd be in the middle of some battles of who's going to deliver first, who has the bigger balance sheet. So we built that out. So within the BitGo ecosystem, you can settle instantaneously, get rid of that counterparty exposure. And I agree with Carolyn on tri-party collateral management. We've added 20 secured parties, 75 pledgers. We can accept all 800 coins and tokens in tri-party. Segregating collateral from counterparty is key to be able for this industry to grow safely going forward.
Cool. Teddy, Jean-Marie, from your perspective, what demand you seeing from your customers on new investment products and what you guys are working on today?
Yeah, so I think we started the conversation talking about institutional adoption.
Yeah.
I think in the institutional community, broadly, by far, Bitcoin is still the dominant narrative. It's because think about that story I told of the hands not going up in the room. That the rest of the room, the thing that they know about, the thing that they're going to get comfortable with first, is still Bitcoin. And so I think when we talk about the mass affluent of America, financial professionals, financial advisors, putting those individuals' money to work, it's going to start with Bitcoin, and it's going to be like every other cycle that we've seen in crypto so far. It's going to roll downwards from there. I think Adam brought up a good point about Ethereum ETFs in the U.S. having some deficiencies because they don't participate in staking, which means that they'll forego some of the available yield in the form of staking rewards. But after that, talking about maybe more sophisticated pools of institutional capital, we see a lot of interest in yield generation. So, for example, if you are a sophisticated pool of assets, you've already been long Bitcoin for a number of years, or maybe you've made some crypto venture investments, you've invested in some companies, you like your Bitcoin investment, but you want to earn some yield on it. Or maybe you like crypto equities, but you want to earn yield on those. I think that's just sort of the maturation of the asset class. As people get over that first hump of first getting familiar with Bitcoin, understanding the investment case, investment thesis, that's how it kind of moves along, and I think it's pretty natural.
Jean-Marie?
Yeah, just go back to portfolio allocation. We started with beta. Beta is happening right now, but not even in second or third inning, but even in first inning. We didn't start the model allocation where, BlackRock turned off allocation to 1,000 ETF in one go, and they all get 1% in the portfolio because guess what? It's improved the Sharpe ratio of the portfolio, and it's a great news. So that's a big next wave of adoption. Once this kind of beta allocation is done, you're entering to the next phase, it's going to be like the income fund based on Bitcoin and based on a few crypto, and we go back to the staking discussion and launching in 2024 ETH staking product, ETH ETF without staking is clearly showing you don't understand what is happening in Ethereum market or with staking products. So, at CoinShares, we took the natural decision not to go for this application in the US because it was betraying the value of the protocol, and we kept the ETP stake one in Europe for our clients. So hopefully there is some progress in that direction in the future. And then you go into the hybridation. So you go ETF who can do active management, and you go into private fund, and you go down the model. So I think it's a step by step. The beta is getting covered slowly but surely, and then we're going to enter into a much more alpha and income fund.
Great. And so if now we look a little bit at the state of all the back office infrastructure tooling that is needed to support the growth of all these like regulated financial product. If we start with the custody piece, Caroline, so obviously you mentioned that the custody products are a big part of what you guys are doing at BNY Mellon. And you mentioned also it seems that really the value of why people should custody at BNY is because of the integration that you have with like all the different services. But can you tell us a little bit more about that and what should like asset managers and institutional investors look for when they look for like custody services?
Yes, look, I think if you think about how the world grew up, right, there was securities and cash living in two parallel infrastructures at minimum, right? Even within, when you go underneath securities, you have 50,000 different, infrastructures. But security and cash alone live very parallel to each other, but not perfectly integrated. Blockchain technology gives us the opportunity to sort of break those divides a little bit more. But we should be really mindful of the fact that we have regulated products in the market. We have a whole ecosystem supporting the ability to deliver those services at scale. And I think it's going to take us some time to have real efficiency in that. So you need to have that bridge between the digital and the traditional to make sure that on behalf of asset managers, we're clearing out that potential last mile friction that's there for us to really take advantage of what a digital asset can do. Because a digital asset can only be as mobile as the back-end infrastructure is. And I think we've still got this like interesting chicken egg in the industry where we're still talking about that layer one infrastructure. So that kind of is telling to the maturity. It's kind of like the hands going up. Like the fact that we talk about blockchains and which chain and private, public, yada, yada. We're still at that very kind of early stage of innovation where we're taking a few steps forward and then a few steps back. So it's not obviously like innovation's never linear. That would be an easy job if it was. So I think for us, it's very important to keep that connectivity and keep chipping away at efficiency. Like that's our job, right? We need to make sure that we're bringing scale to the market in a way that is removing frictions where possible and not taking advantage of a bank of the frictions that exist in the market so that we can enable those assets to do more. But it goes back to, again, when you're talking about liquidity in particular, and you're talking about the new evolution of assets that are starting to come to market, they need to be able to tap into the liquidity that exists in the traditional market. So it's not just a connectivity bridge, it's how do you actually enable that leverage of liquidity. So again, whether it is the collateral that we talked about, whether it is just the trillions of assets that we sit on, it's that tapping into the liquidity and being able to build these products across the ecosystem that enables that. That's absolutely critical. And designing that up front. Also being mindful, I know there's a lot of control type people in the audience, but being mindful of when you leverage blockchain technology, you create digital assets, you create a speed in the market that can actually become a problem if not managed up front. So again, when we're sitting here with the scale that we have, with the centuries of experience we have, we plan for things to go bump in the night every single day. And I think when we talk about, again, we talked about the speed of a tokenized asset moving into tri-party, you could have a potential liquidity run on many of those assets. We're the number one clearer of US treasuries. We worry about this every single day. It would be great to have a tokenized treasury market that is linked into custody, linked into collateral. But let's build the speed bumps to make sure that if something does go bump, and for investors to be able to like actually screech to a halt. So the concept of circuit breakers that exist in equities, building that in. So when we're thinking about our infrastructure, we don't just think about the pure connectivity. We think about those sort of extra levels of risk that this technology could accidentally introduce as well. And building advocacy in the market through regulators. We operate across 120 markets. We have some ability to be able to educate across the globe as well. So even on the collateral side, I co-chair the CFTC's GMAC Digital Asset Market Subcommittee, which is a mouthful. It's a very interesting committee, but we've got 50% of crypto natives and 50% of traditionals on that committee. And we're hopefully about to introduce a recommendation to enable tokenized assets for collateral. Right, so getting rid of that like regulatory hurdle that exists, because even if all of four of us line up and bring the technology to bear, bring the investments, the creativity of products that you guys are building, we still need that last mile on the regulatory side. So it's more than technical infrastructure.
And maybe to stay a little bit on how you educating and working with the regulators. So obviously one of the recent news was the exemption of the reporting requirements for sub 121 for your custody business. Maybe can you tell us a little bit more about that? And should that be taken as sort of like a sign of hope by the community, or like how should we read that news basically?
Yes. So what we did was, again, we launched our custody business in October 2022. We took every single thing that we built in terms of our risk principles, and we evidenced those to the OCA, part of the SEC. And we said, here's how we're protecting those assets. Again, as a custodian, what we do is safe keep assets, right? So we were able to demonstrate not just the technical, but the operating model that we had around bankruptcy, remoteness, and all of the principles that, frankly, the entire industry should take the blueprint of what we presented and build your products that way, because this is how you bring institutional grade standards into this market so that we can protect the assets of all of the investors in the market. It took some time, right? And I think there is a resiliency and a persistence that one needs to put into this. But we are hopeful that on behalf of everybody else that, should frankly speed up and start building products, that we can now get to the place where we have a more efficient operating model where we have many custodians operating, and we can bring on competition and start differentiating on the value that we can create versus the ability to actually participate. So we're very excited about it. Again, we'll be bringing products to market even in custody in a very slow and measured way, because it is novel, right? And there are different types of risks once you go underneath the hood of what different asset it is, what market that you participate in. But that's what we do as part of our kind of 101 of custody anyway. So we'll be applying all the same principles. But I do see it as a hopeful measure, particularly for the US, who arguably is catching up with Europe. And I hope that others will start to enter into this market. And again, we can thrive then more on the competition that I think will enable clients in a different kind of way.
Very cool. And yeah, guys, how do you think about on the asset management side? Like, what are your learnings of working with different custodians, and kind of what's the strategy interacting and working with the different custodians out there? And then obviously we'll love to hear your view, Adam, as the custody provider. Maybe we can start with you, Jean-Marie.
Yeah. So going back to first principle, you really live and die in asset management through your custodian. So there is no other way around it. The reputational risk you're carrying is down to your custodian. So your custodian go under, you're not going to keep a business. So part of the value we have in an asset management company was to be able to identify very early on the right custodian, the one who understands what stewardship of the industry mean, and how does that apply. The very first custodians in the industry are not around the table today. Elliptic was the very first custodian in the industry. It is now a forensic company. So it is a hard business, and a lot of people give up in the middle. And it's great today to see a name like Bonnie, but to give you a little example, at CoinShares before 2017, there was no real custodian we can work with. It was Xapo, who was kind of a libertarian idea and was working. And basically it was Ledger as a technology solution, but nothing else. So we were kind of hacking our way into it until we saw that effectively Twitter was starting to ask questions about, oh, where are these assets they have? And then we started having the regulator saying, by the way, we don't really understand this custody piece. Like, how do you keep this asset, you say? And then your auditors, we're signing up a balance sheet for $2 billion this week in 2017. And the auditors, we had to send him an email. We still have it on file, which is saying, if you lost your printer, your pen, or anything, let us know. We can bring you what you need to sign the audit this week. Because every day was a new excuse for delaying the signing. I was like, so the poor audit firm was shaking, saying, where are these assets? Or how do we know for sure these assets are there? And that the absence of custodian was a massive problem at that time. So we created Komainu, which was a joint venture with Nomura and Ledger. And Nomura at the time put their reputation behind that to say, yeah, we were a 100-year-old bank in Japan without any risk of default or history of default, and we're going to put our name on the door. And then all the banks start joining the journey until Bonnie arrived today. So it has been a very, very long journey to get proper institutional around the table. In terms of how do we manage that today, obviously we have our own custody relationship, but we tend to diversify ourselves. We can't be seen as, putting your eggs in one basket. If you were to do it with prime brokerage, you will have one or two prime brokers just to get a bit of competition behind them. No comments, Adam. But also to just like diversify your risk. So you really want to get people like Adam Firm, you want Caroline Firm tomorrow when we can onboard with them, and other firm to all pitch in. So as effectively you limit your risk. Like custody risk remain my biggest risk at the company, along with cybersecurity. People tend to forget that custody and cybersecurity in crypto tend to mean the same thing. There is no kind of, when Katrina happened or last hurricane happened in FIDI, people were putting to dry the certificate notes who were flooded. In crypto, it doesn't happen this way. In crypto, it disappears overnight and there is no recall button. So it's a little bit more immediate. It's a little bit more instantaneous. And you can really lose sleep against above it. So cybersecurity become your critical function beyond custody. And once you get that in place, the question is like, how do you report to your client and how do you make sure your client sees through? And because we get this custody solution, which are now effectively digital ledger, we can start competing with what GLD was doing back in the day, where you buy GLD, you go on the website of BlackRock, you can see every single bar GLD owned by the bar number. And so we were like, okay, well, we get the custodian, we get the GLD model, so what do we do next? And then we went to convince an audit firm in the US called LedgerLens, or network firm today, to become the first CPA and audit firm to drive hourly attestation. So we were able to just start disclosing this kind of bar list, but which is effectively a coin list, as early as 2018 on an hourly basis on a proper audit attestation, not just it's just the blockchain telling you. It's like the blockchain tell you and the auditors sign up on an hourly basis, the attestation. And that's kind of how you drive adoption. Custody is really a public good. It shouldn't be owned by, if you look at the balance sheet of the big exchanges, they're all owned by every single market maker and market participant. The way we thought about custody back in the day was exactly the same thing. If our investment in custody in 2017, we own 2% in 10 years, we will know we did the right stuff by making it a public good and opening up to everybody.
Cool. Maybe Teddy, you can share a little bit also the experience dealing with custodians, but also you said, you mentioned something that I wanted to talk about also with you, Teddy, is around so you guys have been around like the first asset managers that are issuing a Bitcoin spot ETF to actually publish addresses, Bitcoin addresses, so that people can see the assets that are being held on this. So I'd love to hear a little bit from you, like what was behind these initiatives and how basically as asset managers you want to leverage blockchain as a tool to increase transparency and and trust. But if you want to say just one comment on dealing with custodians first, like, yeah, 52.
Yeah, I'll quickly build on what Jean-Marie said, and without spending too much time on it, I would just echo the point. We launched our first private crypto index fund in 2017, and let me tell you, the service provider landscape at that point was rough. There was only one fund administrator that was servicing clients in the industry, really, and they couldn't service our fund because we didn't want to have only quarterly liquidity in the product. There was only one custodian that was offering custody services out of any kind of regulated entity, without passing judgment on how that entity was regulated, any kind of regulated entity at all, and they couldn't even support the top 10 coins as measured by market cap. So if we wanted to have a fund that had more than 5 or 6 assets in it, we would have to resort to finding a way to store the assets ourselves using cold storage and ledgers and air-gapped computers. And forget KPMG, who, thank you, works with us now as our auditor. You only had maybe 1 or 2 tiny regional firms that could sign off on audit opinions. So the landscape, not just for custodians, but if you really want to zoom out and think about the development of the asset class, think about who is sponsoring the event that we're at today, think about who's sitting up on the stage. It's way different in terms of the ability to service funds, service businesses, provide assurance, do tax, financial reporting. It's just in that area, it's a remarkable change in the landscape, which is a thing that institutional investors need also, and it's a thing that the industry needs. And then just on the transparency piece, yes, we're very proud at Bitwise of the domestic ETF issuers of Bitcoin ETFs. We publish all of our Bitcoin wallet addresses on our website so that investors, if they want to, can go and look and see the Bitcoin that the ETF holds is publicly transparent. They can look at it in any block explorer that they can search up online. And we really think that it's one of the reasons that the ETF has been one of the most successful financial innovations, as I mentioned, is because it brings an unprecedented level of transparency to financial products. And one of the reasons that blockchains are so amazing, of course, the Bitcoin blockchain being first, is because they too bring a newly unprecedented level of transparency in terms of people being able to see what is actually going on the ledger. And we think it's a great marriage of the two things, that we can put those two together and be able to demonstrate that transparency for our investors. So we're excited about that. We're glad to have done it. It's a little nerdy, but we like it.
So I'm going to spring off your nerdy, because even when we talk to regulators about transparency of blockchain technology, and you think about at the core of what a custodian does in terms of keeping assets safe, the ability to know how that counterparty is behaving in the traditional world, that's FTP files after the fact, right? That is not instantaneous. And right now we can see every single transaction and every breadcrumb related to that transaction in real time. The regulators could too, by the way. Yeah. And I think that brings a level of security to the asset class that doesn't exist in the traditional asset. And I think it gets forgotten because I think it's the hidden dark web. And yes, cybersecurity is a whole nuance to how you actually keep these assets safe. But we can actually do our job when it comes to AML, KYC, in a much more effective way than we can on the traditional. So hopefully the traditional worlds will start to adopt into that. And again, I think regulators could actually be participants. They can manage nodes on the blockchains from that perspective of being able to manage, where there is potentially bad behavior and bad actors happening. Yeah. But that transparency does not exist in the traditional world, and people forget that.
I get a funny insight on that one, where there's a cliquet effect about the transparency, because, as I said, we used to publish this hourly attestation with our audit firm, and one day our CTO called, said, "I look at the numbers; they don't change that much. We should just publish it like every half a day, effectively." We say, "Okay, let's do a half a day. It doesn't matter. Our client won't mind, and that's fine. It's still twice more than the normal statement you get from your bank, so it's still a good enough result." Well, guess what? Within a week, I get a phone call from the regulator saying, "Yeah, we were very much liking this hourly reporting. Can you go back to this hourly reporting, because it's much more transparent?" Yep. So once you go back to this kind of granularity, it's very difficult to wind it back to less granularity, even if the value add is kind of marginal.
And maybe to close and before opening to the audience with you, Adam, and related to what Teddy and Jean-Marie was saying. So obviously now the space has evolved and there's more custodians out there and they're very much mature platform. How do you guys differentiate yourselves, and what do you think asset managers should look for looking for custody services?
Yeah, the custody space has definitely come a long way from 2017. So, look, I think we touched on a lot of it. I think qualified custody is a key for asset managers, right? When I first joined the space 2.5 years ago, there were a lot of custodians out there that said they were custodians, but they weren't a state-chartered bank. So when the SEC came in, there's been a lot of focus for those asset managers to make sure that as much assets as can be supported are in QC, and that's where we've been working with our clients. The conversations have really changed over that time from I just want my custodian to hold assets to what we mentioned earlier, to deploy it, right? So whether that's staking, using it as collateral, tell us about your trade, your OTC trading, electronic trading, financing, what kind of margin. Those are to allow asset managers to grow. Those are the conversations we're going once they get comfortable with how we store the keys and our cold storage and the like, and the 10-year track record. So, and then I think the other point that was brought up earlier, which I would echo, is a multi-custodial model. We're seeing that with the largest funds. I spent 20 years in prime brokerage. The largest hedge funds, once they get to a certain size, they use multiple prime brokers, diversify, and we're seeing that it's playing out in some of the ETFs as well, as we've seen some of the ETFs start with one custodian and then add others over time as well.
Great. Yeah, we open to the audience. I have a bunch more questions, but I guess the questions also have questions. So yeah, go for it.
Altin Hoxha, CTO of Platonic.io. I have two questions. One is, how do you think about decentralized privacy and interoperability when it comes to issuance, distribution, usage, and servicing of tokenized assets? And the second question is, what do you think about an opportunity to use on-chain first processing or smart contracts-enabled processing largely for middle office and back office operations?
I think when it comes to interoperability, it's always a word that sparks a couple of things in my head, right? So you've got the traditional digital interoperability, so that's an obvious, right? I think in this world where we're going to always have a diversification of some products that are traditional and some products that are digital, you need that interoperability to be table stakes. So whether it is pure back-end stuff like how you send out your tax reports or your compliance reports, it sounds remedial, but it's obviously a very difficult thing to do. So that level of interoperability. Interoperability across the value chain, which Adam was talking about earlier, absolutely super critical. At some point, we'll stop talking about custody because it will be done right and it will be nicely competitive, maybe not so cheap, but we'll get over that. And it will be able to power the rest of that value chain, and it will be in a very seamlessly integrated way. So the interoperability will be done at the technical layer, where we'll be able to actually leverage it versus these different technical infrastructures that then have to point to each other. And I think that will be absolutely critical. And I think then it gets into that interoperability of liquidity, right? And how do you really bring those markets together in a way that hasn't been done to date? One of the things that kind of unnerve me a little bit about this space is we're getting a lot of smaller groups come together with interoperability plays, because what they're seeing is still this siloed infrastructures being birthed again in this space, and then this synthetic layer of interoperability being created on top of it, which gets to your second question on smart contracts. So for me, it shouldn't be a case of you're building yet another interoperability layer on top of. We've got to get that base layer right and make sure that that kind of layer 2 infrastructure has the right smart contract capabilities. We, by design, we've been using distributed ledger technology and smart contracts implicitly for years in our flows, right? Even like outside of smart contracts, we've been using different forms of tokenization, like a depository receipt. What is it? It's a tokenized asset. It's just not on a blockchain, right? We've been doing that for eons. So for me, it's actually now saying, how do we leverage the smart contract technology to make just the information flow more programmable? I would love to solve the problem of corporate actions over time. I have to build back up my resiliency after fighting the good fight for the last 4 years. But I do think that's another obvious play, right? How do we, particularly on the custody side, leverage those areas? Programmable money is another one. Again, I go back to that like layer between the cash and the security sides. So if we talk about interoperability of that, again, I think we have now a technology tool that can enable that to be done, where then what we can do is actually compete more on the app layer and the experience layer and not this base infrastructure, and we can leverage the technology to do that.
Anyone else? Any other question?
Hi, my name is Jacob. I'm the CEO at Winter. Teddy, you said that we need to wrap crypto into a financial wrapper so that people can invest. And Jean-Marie, your product has been to wrap the first Bitcoin into an ETN in Europe. Now, will there be a point in the future when we don't need these financial wrappers at all and people just invest straight into the tokens themselves?
There is a big convergence theory, if you look at just MiCA, the name isn't very far away from MiFID. So the convergence is happening. On-chain asset management is coming as well, and you need a few infrastructure play like what Bonnie is building to be able to deliver it at scale, because what you see right now is like a vast landscape of tokenization platform. There is too many candidates for what there is to be done. You need to get like a legacy firm to step in with their book of business and say, okay, with tokenization, the direction of travel, and at that point, the industry will follow. So, yeah, you can think in terms of infrastructure, how they are transitioning to a fully, permissionless or not, to be discussed with the main players, and the new asset management regime, yeah.
Yeah, I think, Jacob, you're absolutely right. In fact, maybe one of the things that can be frustrating about working in crypto, and you've described, Caroline, you've experienced yourself, you can see clearly what the future is. You know what is going to happen, but you just don't know when it's going to be allowed, or then when the traditional industry is going to pivot into it. So you're absolutely right. Like, people ask me all the time, like, why do I have to buy Bitcoin in an ETF? Isn't it like taking an asset that I can buy on chain and now going backwards in time by taking it off chain? And the answer is, yeah, that is actually what we're doing. But that's the way that the financial world accesses their investments right now. And until that transition occurs, it's a big transition, to be fair. It's a huge transition. It's multi-year, probably multi-decade thing. But absolutely, using blockchain rails to facilitate asset transfers, cash transfers, anything that's tokenized makes more sense. It's a better technology. It's a better solution, and it's going to happen. It's just, again, it's when. How is the regulatory environment going to adopt? How is the existing infrastructure going to adopt? And it takes years.
Yeah, and I'm just going to add on to that. You've got to differentiate the technology from the legal and regulatory rules, right? And I know it's an obvious statement, but like, in the end of the day, when I saw the proliferation of tokenized funds, it was a bit of the, why on earth would you do that, right? Especially money market funds. What's underneath them? Mostly treasuries. Why not just tokenize the thing, right? Why do you need the wrapper? Well, you need the wrapper because the fund has a whole legal infrastructure, tax infrastructure that's around it, right? So it's that concept of standing up and walking first before you can actually run and sprint to the end. That end is, I mean, we can all take a gamble, but it's, you're talking multi-years out, right? So I think you got to walk first. There's still a little bit proof that technology can do what it can do and that it can scale. And I hope that what we're doing in BNY enables folks to see that, because that integration back into the deep pipes and plumbing that are behind us can actually take the conversation away from the power of the technology, and then it can enable the technology to do what it can do because we can get focus on the reg and legal structure.
Cool. I think that we can stop here. Thank you very much, guys. It was an amazing conversation.